This industry is going to be producing intelligence, and what it takes is energy and, of course, a lot of great computer science and large computing systems that Nvidia makes. And so we've got to make sure that everybody understands the needs coming, the opportunities of it, the challenges of it, and do it in the most efficient and scalable way we can.
Well, that, of course, was NVIDIA CEO Jensen Huang speaking to CNBC outside the White House today. He was there for a meeting about the outlook for AI and how to meet the energy demand needed to power that industry. NVIDIA shares making a huge comeback this week. And top chip analyst Bernstein's Stacy Rascon says it remains one of the best names in the industry. Joins me now. It's good to see you again. So we heard a lot from Jensen this week, whether it was in the leather jacket or the business suit. What was your biggest takeaway from either Communicopia out here where we were in San Francisco or from what he said outside the White House today?
Yeah, look, I think he's right. You know, you're right. The stock has been through the ringer up and down and sideways over the last few weeks. There have been concerns about Blackwell, their next generation platform, the Blackwell delays and sustainability of demand and everything else. And look, at this point, from everything that we can see, you know, the demand remains off the charts, right? I mean, it seems like their customers just still cannot get enough of what it is that they're delivering. And I think he's right. I think as we go forward, like you can never have too much compute, and they are, you know, they're the ones that are supplying the most of it at this point. I think the concerns around Blackwell delays, which was from a few weeks ago, those have sort of proven to be mostly a nothing burger. They've got a good amount of that, billions of dollars of Blackwell revenue ramping in Q4. We'll have all of next year to ramp that platform as well. I still think this one has legs. I still think it has room to run.
Over the previous 5 years, Nvidia's stock has surged dramatically, reaching $1,000 in early 2024. This happened when the business established its hegemony in the artificial intelligence, AI, chip market and consistently produced triple-digit increase in earnings per quarter. Not every investor can afford a stock price that is close to or above $1,000. Nvidia initiated a stock split in early June after realizing this. By issuing extra shares to current holders, stock splits reduce the price of a company's stock per share. However, these actions don't truly lower the price of the stock because they don't alter anything essential about the company. Even said, investors who weren't prepared to commit hundreds of dollars or more before the split might still be drawn in by the reduced price. It's reasonable to assess Nvidia's performance thus far and wonder if the stock market darling can continue to soar as we approach the third month following the split. Let's consult the past for guidance. Back in May, when shares were selling for more than $900, the firm announced that it was going to divide its shares. Following the announcement, they surged above $1,000 quite rapidly. From the time of the announcement until the split on June 7, the stock continued to rise by almost 30%. Due to the 10-for-1 split ratio, the shares debuted on June 10 at roughly $120. Since then, there have been some ups and downs in Nvidia's share price, but overall, it has dropped by roughly 4%. Hence, our performance is very different from what we were used to seeing from Nvidia earlier in the year and in 2023. Where will the shares of Nvidia go next? Based on historical data, 2 out of the 3 prior Nvidia stock splits saw double-digit gains in the stock within the first 3 months following the split. However, during that time, the shares for the other split dropped by double digits. Using that historical example alone, Nvidia has had mixed but generally good results in the months after a stock split. If you want to keep up with Nvidia's latest updates and keep up with the stock market latest news, you can subscribe to our investing tutorial channel as we post daily updates about the biggest changes and catalysts in the market. So click the subscribe button if you don't want to miss the newest market updates. Now back to today's video.
All right, let's talk about Nvidia as well here. Shares are relatively flat in pre-market trading after closing higher by 8% on Wednesday. The surge coming after CEO Jensen Huang touted the extraordinary demand for AI chips at the Goldman Sachs Communicopia and Technology Conference on Wednesday.
Demand is so great that delivery of our components and our technology and our infrastructure and software is really emotional for people. Because it directly affects their revenues, it directly affects their competitiveness.
Huang pointing to the intensity of the demand being so great that their customers get emotional when the supply can't always meet what they want here. And that demand has certainly benefited NVIDIA to this point. And some of the entrenchment that they've been able to put forward for themselves has really come back to CUDA, which we've talked at length with several analysts about. Stacy Rasgon, one of them we've talked about CUDA with, and how that compute unified device architecture, what it stands for, how that's really been part of the thesis around NVIDIA. But then you start to think about, okay, if NVIDIA is unable to meet some of that demand, who are some of the other players that could win or at least take some market share in the near-term period? Is it competitors like AMD? They have a company that they bought called ZT Systems, helps bring in systems expertise. It was kind of an engineer acquisition, but all these things considered, an acqui-hire as some people would call it, all these things considered, it's looking at some of the other stock plays that could potentially benefit as NVIDIA is trying the best it can to meet demand and where other players can at least pick up some of the chips that are falling off their plate.
Yeah, and I think that's exactly been the narrative surrounding Nvidia stock, right? Just the fact that they have such a dominant position right now. When you take into account the estimates here for AI growth down the line, the chip sector, exactly their role clearly critical here to the adoption of AI going forward. Nvidia is far from the only name in the game right now. Yes, they are the leader, but there certainly are other opportunities for some of those smaller players relative to Nvidia to chip away at that market share. But I think just taking a look at the move yesterday, the significance of an 8% pop on the heels of really Jensen Huang almost just reiterating what we've heard time and time again. Yes, he did say some interesting commentary when it comes to the fact that customers are a bit more emotional because everyone wants to be first when it comes to this technology. But the fact that he did once again reiterate that quote unquote incredible demand for chips also went on to talk about the fact that every dollar a company spends on NVIDIA infrastructure could be turned into $5 in cloud computing revenue. And I think that almost validates some of the concerns that had been, or validates the initial euphoria that we did see play out within the AI trade, and almost puts to ease some of those concerns that we did have over the last several weeks when it comes to, I guess, how quickly some of these companies are able to make money when it comes to their AI investment.
Let's now look at more comprehensive stock split data. According to a Statista analysis utilizing data from the Research Investment Committee of Bank of America, companies that have split their stock have generally outperformed the S&P 500 in a study conducted from 1980 to the present. According to data, in the 12 months after the announcement, split stocks had an average total return of over 25%, which was double the average return for the S&P 500. Why is such the situation? The theory is that if a stock price is down, more buyers will gravitate toward it, giving it a boost. Although this may be somewhat accurate, investors consider other factors as well. Just because a stock accomplished a split doesn't mean they will buy it. Concerns about the wider economy and increasing competition in the AI chip sector have been entrenched in investors' minds when it comes to NVIDIA. High-growth firms like NVIDIA are typically affected by economic uncertainty because they depend on stable economic circumstances to fund their operations. These elements, combined with a little profit-taking, have caused NVIDIA to regress recently. In terms of the future, historical data indicates that NVIDIA has a strong probability of rising in the upcoming months if the stock moves in line with previous trends. However, history isn't usually repeated, so I wouldn't invest in NVIDIA right now in hopes of making a rapid profit. Fortunately, NVIDIA still has enough of fuel left in its tank to continue making progress in the long run. NVIDIA plans to release its most powerful chip to date along with its new Blackwell architecture soon, and the company says it will upgrade its chips every year. Revenue ought to continue soaring as a result. Naturally, some consumers will choose to employ a combination of NVIDIA and competitor chips or choose the less expensive chip from the rival. However, I don't think this will drastically reduce NVIDIA's market share because the major companies in AI often want the quickest and best CPU available to power their projects. All of this suggests that investing in NVIDIA stock now and keeping onto it for the long term can still be profitable, regardless of whether history is correct about the company's future success. So what does this really mean for NVIDIA's stock? Let's find out, but first, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoy them, please hit the like button, subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
Describe the demand that they're seeing when he was on stage yesterday with David Solomon as still being great. He also talked about, Stacey, I think something more powerful, and that's the idea of this installed base that they have, whether it's through gaming or supercomputing, the likes of which we always talk about relative to Apple, but not so much as it relates to Nvidia. The implication being that it doesn't even matter really about some of the competitors who are out there, because the customers of Nvidia are just going to keep coming back only for updated chips that they produce throughout the years.
Yeah, so this gets into the concept of what's known as the ecosystem. So it's an issue, like a lot of their competitors, like the pitch is, we have a chip that's better than NVIDIA, which, by the way, is always open for debate. But even if it were true, it's probably not enough. It's not just about the chip. It's the chip, and it's the software, and it's the hardware, and it's the systems engineering, and everything that goes around it that makes it very, very easy to just buy their NVIDIA stuff and adopt it and install it, and it's up. You can be up and running in days without having to monkey around with anything else. Many of their other competitors' stuff, you can buy it and you try to install it, and it may be months before you're up and running with it. We've even seen evidence of this. AMD now, they've just bought ZT Systems. That was to gain the systems expertise that NVIDIA themselves has sort of built up organically. AMD's been doing, they bought other acquisitions and other things. They're trying to assemble some of those capabilities. It's on the software side and everything else that they have been less successful building up internally because they just don't have the scale. But it is clearly, it's clearly about the silicon, but it's much more than just the silicon. It is everything that goes around it that makes it easy to adopt. And then once you're adopted and once you're established, then you really do have that installed base, a tailwind. Once your customers are using your parts, they're used to programming on your parts, it makes it much easier just to keep doing that.
In a recent note, Goldman Sachs analysts advised investors to take advantage of the current decline in AI stocks, noting that AI-related businesses are still fundamentally sound. The investment bank captioned its report, "Buy the dip in AI." According to them, the AI data centers basket and the AI PC and mobile device upgrades basket have reverted back to the benchmark. But the broad AI basket has fallen 12% from its highest point thus far in 2019. These firms are currently selling below ahead earnings projections, but they beat earnings by an average of 8%, which is almost 3 percentage points better than the S&P 500, notwithstanding this decline. Goldman Sachs outlined a number of important elements that could encourage an increase in AI stock prices. They predict that reduced interest rates will stimulate its initiatives, and that the outcome of the next election will lessen the uncertainties surrounding economic policy. Furthermore, the bank hopes that forthcoming industry conferences will showcase concrete advancements in AI products. Citing recent events, they highlighted a noteworthy statement made by NVDA CEO at a Goldman Tech conference, emphasizing the high return on investment for hyperscale clients, and pointing out that $5 in rental income is produced for every $1 invested in NVIDIA infrastructure. Additionally, according to the bank, AI valuations have now stabilized. Goldman Sachs claims that after a period of high premiums in the spring, their AI data center and wide AI baskets are only marginally valued above the S&P 500. In their opinion, AI expressions are cheap to UETD earnings trends, and additional drops would probably necessitate fresh bad news, which is improbable. In addition, Goldman emphasizes the growing contribution of data centers to the country's power needs, estimating that they will contribute about 90 basis points of the 2.4% CAGR in U.S. power demand through 2030.